Welcome to the ultimate guide for your RSUs, where I'm walking you through the savviest strategies and tips to help you optimize and keep your wealth. I'll also be covering the beginner mistakes that could cause you to lose it all. An RSU is an acronym standing for Restricted Stock Unit. It's a form of equity used to incentivize employees to, one, build the company, and two, it's used to retain employees. But have you ever wondered how RSUs are taxed? It's easiest to address the taxation of RSUs if we look at how they work chronologically. And the first important date to know with your RSUs is the grant date. This is where the company gives you the RSUs. And you don't owe any taxes on the grant date because you're an owner of units, not actual stock. Your company has imposed some conditions that you must meet in order to receive your stock. Hence the name Restricted Stock Units. Because of this, the IRS views you as having substantial risk of forfeiture, meaning there's a high chance that you lose everything, so the IRS won't tax you. Yet. You will incur taxes on the vesting date, which is the second date. The most common types of vesting are time-based vesting, event-based vesting, and performance-based vesting. Wow, that is a mouthful. If there's a single condition to be met, this is called a single trigger vesting schedule. A lot of RSUs have a double trigger vesting schedule contingent upon a 4-year graded vesting schedule in addition to a liquidity event. As soon as all of these vesting conditions are met, the shares are transferred from units to stock, and this is where the taxes come into play. There's no longer a risk of forfeiture at this point, and so the IRS will feel more justified in taxing you, and that's exactly what they're going to do. You will owe ordinary income on the current fair market value of the stock upon vesting, subject to withholdings. This means federal income tax, state income tax, and FICA tax, or Social Security and Medicare tax. Typically, when you earn a salary from your company, they are going to withhold taxes from your paycheck. In the case of RSUs, your company may also withhold money to help cover the taxes that you owe. They may withhold money from your paycheck, or they may withhold shares and sell those to help fund the tax withholdings. Note that most companies will withhold at one of two tax rates: 22% or 37%, which might not actually align with your current tax rate. Therefore, the company might be under withholding, and it's up to you to make up that difference. For example, if your company is withholding at 22% and your actual tax rate is 35%, it's up to you to make up that 13% difference. And this is where you'll need to pay quarterly estimated taxes. And taxes due upon vesting aren't your last tax ramification for RSUs. Taxes also come into play when you dispose of your stock. The next day is the day of disposition. The day of disposition is the day that you sell, gift, or donate your stock. This is what they mean by disposition. And there are tax consequences here, specifically capital gains or losses, depending on if you're selling above or below the fair market value on the day of vesting. If it's been at least a year from the day of vesting, then you'll have long-term gains or losses, or if it's less than a year, then you're going to have short-term gains or losses. And depending on your income, you may also become subject to the net investment income tax. Be aware that if you have any insider information, you'll want to create a 10b5-1 trading plan before selling as an affirmative defense against any insider trading allegations. The nice thing about RSUs is that you don't have to pay for these taxes out of your personal savings. Let's talk about these benefits before we get into the potential mistakes that you could be making with your RSUs. Benefit number one is liquidity. When your RSUs vest and you trigger taxes, you can sell the stock to help fund that tax bill. That's one reason why private companies have a liquidity event as one of their vesting conditions. In stark contrast, stock options don't have that luxury. When ISO or NSO tax bills come due, you can't often sell your stock to help fund the tax bill because your company is still private. In other words, one of the greatest benefits of RSUs is that you have liquidity when the tax comes due. Similarly, benefit number two is also a victory for RSUs over stock options. And that is that you don't have to pay to receive the shares. Or in financial terminology, you don't have an exercise cost. So if you meet the RSU vesting requirements, the shares are yours. It's as simple as that. This brings us to benefit number three. The good news is with RSUs, you don't have to worry about your shares being underwater when they vest. They'll always have some value associated to them as long as the stock price stays above $0. Another potential benefit is related to newer tax law called the Section 83I election. Ask your employer to see if they offer this. This can allow certain qualified employees to defer taxation for up to 5 years after vesting. While deferring taxes can be a good thing, there's also some potential pitfalls with it. Please remember that the information provided in this video is not intended to be a substitute for specific individualized tax, legal, or investment advice. As such, please work with your professional for your own unique circumstances. As you can see, RSUs have some amazing benefits. but they can also come with their own downside. Let's look at some common mistakes that some people unsuspectingly fall into with their RSUs. Then we'll get into some strategies and tips to help you make the most of your RSUs. The first and most common mistake that I see people making with their RSUs is holding onto them after vesting in hopes for a better tax rate. It's flawed to think that holding onto your RSUs for a long time will bring some added tax benefit. To prove my point, let me show you a graph of tax outcomes if you were to go out and buy any regular stock. Let's say your company's. Now let's compare this to the tax ramifications of RSUs after they vest. Do you see any difference? Neither do I. That is because outside of the stock being given to you upon vest, there are no added benefits over regular old stock. In fact, it only brings added risk, which leads us to the next mistake, which I'll start with this. Think about it. You may be overexposed to your company via your salary, stock options, RSUs, ESPP, and so on, putting your income and your assets into one effective basket. If anything terrible were to happen to the company, you could lose your income and your assets. Ouch. Talk about a double whammy. This risk is so subtle because it happens without you having to do anything. As your RSUs vest, you passively become overconcentrated. If you didn't have RSUs, would you have gone out and spent large portions of your net worth on company stock? Probably not. Please don't make this mistake by forgetting about the importance of diversification. If you're looking for a professional to help you diversify out of company stock in a tax-efficient manner, my firm specializes in this and we have limited room for new clients. More information in the description below. Another mistake that people make is not understanding taxes. Here's the catch. Oftentimes people try to offset the concentration risk by implementing complex financial strategies that end up hurting them in the process. One way people try to offset or hedge this risk is through utilizing calls and puts. While often not recommended nor permitted by your company, if you perfectly offset the risk with calls and puts, the IRS can treat you as if you had sold the stock. This is called constructive receipt, when the IRS taxes you as if you had sold, but in reality, you haven't had any of that income hit your bank account. Can you see all the different things that we're trying to balance here with your RSUs? When you sell for a loss, the government is willing to let you write that off to offset other income and gains. But what they don't want you to do is to write that loss off and then immediately go back and buy that exact same stock or one that's substantially identical. And if you do this, they will disallow the loss. This is called the wash sale rule. So if you're trying to sell for a loss, as your RSUs vest, that could be interpreted as you purchasing the stock, thereby disallowing any losses. So you wanna make sure that you're aligning any losses that you're trying to write off with important dates of your equity. Yet another mistake that people make is when they're so smart that they scheme their way into moving into a different state that has lower or no income tax. The reality is that you might not be able to avoid paying taxes from the state that you just moved from. Some states have a trailing tax liability, which means that you still owe them taxes even though you're long since moved. We're covering a lot, so I've created an RSU cheat sheet that you can download for free in the description. I'm gonna let you in on another gotcha. There's something called the 83B election, which allows you to pay taxes on the grant versus the vesting date and have all subsequent gains from grant to vesting taxed at the advantageous long-term capital gains rate. Problem is that it doesn't actually apply to RSUs. So many people get confused by this. It applies to restricted stock, not restricted stock units. I know it's confusing, but those are two separate things that I wanted to make you aware of. When you pay your taxes, is correctly reported on Form W-2. A problem rises, however, if your broker, for example, Fidelity or E-Trade, reports that same income on Form 1099-B. So avoid this mistake by paying attention to your cost basis on Form 1099-B. You may have to make an adjustment to avoid double taxation. While most of the tax mistakes thus far have been caused by people trying to outsmart the system, this last one comes mostly from ignorance or unawareness. So what's that mistake? Your company not withholding enough taxes and you being surprised by a massive tax bill. And this problem can be compounded by something that I'll address in the tips portion. Another common mistake that I see is a cognitive error that causes people to mismanage expectations and can cause financial ruin. This mistake happens when you first start to calculate what your RSUs are worth. And there's a few problems with this. First, you haven't earned the shares. You could still lose them if you don't meet the vesting requirements. Second, you're not guaranteed that the shares will be worth as much as you expect when they do vest. And third, you probably didn't account for the taxes that you will have to pay. And taxes could be as high as 50%. I'm gonna talk about ways that you could potentially reduce your tax bill that you have to pay on RSUs when I get to my tips. Let's say that you're expecting a $200,000 RSU payout. You'll likely increase your lifestyle and imagine all of the things that you're able to buy. In reality, you might only receive $75,000 after stock price movements and taxes. This could be detrimental for your financial future. That's why I say whatever you think they're worth, just disregard that because expectations are an appointment for for disappointment. One last mistake that I see is when people don't pay attention to their vesting schedule and they leave the company before an important vesting date. While I don't want you to make a decision solely based on the equity alone, it's worth checking when your RSUs vest. That way you're not jumping ship or leaving the company before you get a massive payout. If you leave early, you could lose all of your unvested RSUs. In this respect, all of your RSUs are at stake. Just know that your company may leverage your RSUs to get you to stay at the company longer. Here are a few of their strategies. Get you to take a lower salary for increased equity, making the equity seem more valuable than a salary. They may also have a monthly vesting schedule, which makes it more difficult for you to leave because you think to yourself, if I just stay one more month, then I'll get those additional RSUs vested. Lastly, they'll try to never let you fully vest. As soon as you approach being 100% vested, they'll give you another RSU grant, incentivizing you to keep working at the company longer. If you're finding value in this, please hit the like button down below. Don't make decisions based on what the company wants for you. Instead, take a holistic approach to making decisions. Here's some strategies to help. The first approach is to sell everything immediately upon vest. As I've already shown, beyond vesting, RSUs provide no benefit beyond any other stock. Selling everything immediately can reduce the concentration risk in your portfolio. And don't worry, if you sell everything immediately upon vest, you won't owe any additional taxes beyond that which you just paid when it vested. Depending on your unique circumstances, a diversified portfolio may be a good place for your proceeds, assuming you don't need the cash in the next few years. Be aware, however, that this approach does remove you from any future appreciation that the stock experiences. Strategy number 2 is selling over time. Look, I get it. You've worked hard in your company and you believe in its future. So it may be hard to immediately let go of all of your shares. The good news is that you don't have to do this all at once. Behaviorally, this makes it so much easier to stomach if you're just selling, let's say 20% per year or some other variation. And if the stock appreciates, there are tax efficient ways to unwind from these positions, such as gifting to charity to avoid realizing any gains. There are more tax planning strategies that may apply depending on your unique circumstances. If you're looking for a professional to help you diversify out of a single holding in a tax-efficient manner, my firm specializes in this. More information in the description below. A third strategy is to hold the stock indefinitely. I'm gonna guess that more people do this than they should. Not because they're making a deliberate choice to invest in their company, but because this is the result of inaction, which is kind of unfortunate. While it can make sense to do this, you just have to be aware of the risks, which I've already discussed in the concentration risk section. That being said, if your stock performs well, then you get to enjoy the future appreciation. So it's a balance of risk and reward. The more your finances are healthy and in order, the more likely you can afford to take on this risk. Even if you choose to hold your shares indefinitely, you should still sell some shares to help cover any under withholding taxes. And I've worked with people who thought that they would sell after the stock price went up, but the stock actually went down. So they had to pay a big tax bill with small stock proceeds. Don't try to outsmart the system. Speaking of trying to outsmart the system, this leads us to the first of 3 RSU tips that I wanted to share with you. Tip number 1 is to make a plan. I want you to be proactive, not reactive. And if you don't have a plan, you're going to become subject to your emotions and try to outsmart the system, most of the time to your disadvantage. So you'll want to plan for how and when you're going to exit. For example, you may choose one of the strategies that I just covered as a starting point. You'll also want to create a plan for your proceeds, ideally before they vest. Yes, you shouldn't be anticipating a certain dollar amount, but you should still have a general idea of what you want to do with the money. But do you have a job for that money to do when it does vest? A down payment, a home, or perhaps mounds of chocolate rich in flavor? Sophisticated investments. When you read the RSU documents given to you, make sure that you highlight the important information. Literally write down the vesting dates, as this can help you avoid wash sales and leaving before a big vesting payout. It can also help you optimize lower tax brackets and decrease the amount of tax that you have to pay through planning with a professional. If you're looking for professional help, more information down below. Tip number 2 is to manage your expectations. I think it's fair to say that your RSUs aren't going to be worth what you think they're worth, either for better or for worse. And if you don't understand the taxes, you'll definitely be disappointed with your proceeds. While there's no way of knowing what exactly your shares are going to be worth on the day of vesting, you want to ensure that you show up with a plan and without expectations. I want you to be informed, but I don't want you to be raising your lifestyle for some lofty expectations. Fair? Cool. Tip number 3 is a behavioral trick to make you view RSUs more clearly and to make better plans. When your RSUs vest, think of them as a cash bonus. How would you spend that cash? When you make financial decisions, your emotions and your cognitive biases can really murky the waters. We need to remove these from the situation because your finances are on the line, and treating your RSUs as cash can help. If you decide to sell your stock immediately, it can quite literally make you think in terms of cash. This approach counters misconceptions and behaviorally forces you to think hard before you buy back into the stock. You might not want to miss out on any potential gains from your stock, so you're welcome to buy back in after you answer these 2 questions discussed in this video right here.